What is going on, investors? Hopefully guys are doing well out there, and I know you're doing well because it is the start of earnings season here on the Investor Channel. We kick things off like we always do with JPMorgan Chase, one of the first companies to report during this season, probably the most significant companies to report. Now, I know some of you are sitting back and thinking, I don't care about JPMorgan stock. It's so boring. It's a bank. Well, over the last year, if you'd put your money into this very boring bank, you would have made a 45% return. You would have got some dividend yield there as well. Year to date, while this is not NVIDIA or anything like that, you're still up 11.5%. Now, after the company reported their Q3 earnings, shares of the company are popping about 3%. We are recording this during the regular trade. We are going to get into the high-level revenues. Some surprising things here. One of the reasons why you follow these big, boring bank companies is you get a window into the consumer. So whether you're interested in JPMorgan or not, this is how you educate yourself as an economist. This is when you're reading all those doom and gloom things on Twitter that says we're going into recession. You should be buying Bitcoin and putting it on a USB stick and put it in your safe. Well, looking through JPMorgan's financials gets you an idea whether or not that's something you should run out and do. And then finally, we'll look at this from a technical perspective. As you can see, we've got just a beautiful, like a 30-year technical pattern. We've had some deviations above and below. We'll show where we are at today as it relates to JPMorgan. Like I said, year to date, stocks up on 11, we'll call that 11.5%. Over the last year, you're up 45%. Over the last 5 years, not great. You're actually up 40%, but you stretch it out to about the 10-year chart, and you're more than keeping up with the market at over 177% return. Company reported their Q3 earnings. You had a beat on both the top and the bottom line. Now, the company reported their financials, including First Republic, but in the footnotes, they exclude it. We'll not really care too much about that because more or less JPMorgan got First Republic for a song and a dance, and it is tangible to their revenue growth. In fact, they report net income being up 35%. Company-wide without First Republic, it would have been up just 24%. So some real significant gains there as it relates to First Republic. Revenue, 22% year over year. We do see quarter over quarter. That's what JPMorgan gives you. This far left-hand column is our most recent quarter. The second column, or the middle column, if you will, is the previous quarter, so last quarter. And then a year ago, year over year, is that third column. Year over year on the revenue side, we're up 22%, but quarter over quarter, we did see a decline of about 3% on that revenue side. What I also noticed is the non-interest expense. This is all your expenses not related to the interest that you're paying for deposits and those types of things. Well, that was up 13% year over year. Again, no real concern considering your revenues are up 22%. Of course, your interest expense are going to go up by about 13%. One thing that we'll have to keep an eye on is your revenues declined quarter over quarter, yet your interest expense climbed by about 4%. That's why when you look quarter over quarter on the net income side, you went from about $14.5 billion down to $13.2 billion. But year over year, you're up a whopping 35% on that net income. Again, some of that has to do with the fact that they bought First Republic Bank. Now, we glossed over the most important thing, and those are those provision for credit losses. Those of you that are predicting some kind of deep recession will be expecting these to climb. Now, the banks can be wrong, right? But there's a lot of regulation, a lot of stuff that's been happening to these banks really since the great financial crisis back in 2008 that really makes them be very, very judicious. Now, again, I'm not saying that this is like a recession indicator or avoiding a recession, but what I saw in the most recent quarter for JPMorgan is the provision for credit losses were actually down year over year and quarter over quarter. In fact, aggressively quarter over quarter, those declined. Now, we'll just cover the most important banking segments, the community and consumer banking. This is your mom and pop banking account, your home lending, and your credit card and auto services. Net revenue up 29%, and even quarter over quarter up 7% as that banking industry consolidates. I think we'd expect this with JPMorgan, right? I mean, there's like three banks you can bank with these days if you want to go with one of the major ones. And certainly what happened at the beginning of the year where you had those bank scares at First Republic, which is now JPMorgan, and there was SVB, Silicon Valley Bank. I knew some people in Silicon Valley that actually banked with them. Yeah, you took your money out of there and you ran. You ran to a JP Morgan or a Bank of America. Across the board, you were seeing year over year and quarter over quarter increases, and that's what's surprising. Here's your home lending. I mean, home lending. You think this would be in the absolute toilet with mortgage rates at 8%, 7-8%. Year over year, you're up 36% on home lending. You're up 24% quarter over quarter. Where are people getting this money to buy homes? And so this is twofold. One, it shows you, well, the economy actually isn't that bad if you're seeing home lending growth. I mean, you buy a home with kind of the full confidence that your job is going to be there and those types of things. People are still doing this. Now, this also flies in the face that higher interest rates are working. If people are increasing their home buying at 6, 7, 8, 9% mortgage rates, well, what is that going to tell us? Well, the rates are actually probably heading higher, believe it or not. Card and credit card service and automobile loans, those also up as well. Some of this has to do with inflation as well. Okay, so as more people are putting things on credit cards, as car prices go up, and certainly as home prices go up, well, obviously the amount that you're lending also goes up. But what it also is showing us is that interest rates isn't tamping down demand as fast as maybe price is going up. The other thing that I see here is your provisions for credit losses. Yes, year over year, you're up a gigantic amount, up over 173%. So they're setting aside more and more money. But I noticed quarter over quarter, it was actually down 22% from about 1.9 billion. Again, provision for credit losses, money that JP Morgan is setting aside thinking, well, this person isn't going to pay their credit card. They have all these algorithms and all this data, and they know who's late and paying, and they've seen your credit score. They've probably seen you default on other things. They know you're not going to pay, or the odds of you paying is pretty slim. So they start putting money aside to cover those losses. That was down quarter over quarter. And then finally, we'll look at the corporate and investment banks. On the revenue side, you've basically gone a little bit stagnant here. Your interest expense climbed. That impacted profitability year over year and quarter over quarter as well. You're seeing profits slide there a little bit as your expenses outpace your revenue growth. But again, where we're looking here is your provisions for credit losses. They were down year over year and even quarter over quarter. In fact, they actually put too much money aside. Somebody came out of their pocket and maybe paid a loan. And so you're seeing not much distress there, honestly, at least on the provision side. And then finally, you've got commercial banks, strong revenue growth. A lot of this had to do with First Republic. The company would have grown still a very respectable 20%, but it was up 32% on that revenue side because of that First Republic acquisition, a company that did a lot of commercial banking. You're also seeing the trend that your expenses are continuing to rise here at JP Morgan. That is impacting profitability, except again, provisions for credit losses here, down year over year, down quarter over quarter. So this company is actually setting aside less money as it relates to provisions for credit losses. When, again, we looked at the total corporate-wide, this is the entire business line, again, down quarter over quarter, down year over year. It is painting a picture that we're probably not, I think we're painting a picture that interest rates are probably going to stay where they're at, if not climb just a little bit more, but it's not really deteriorating the conditions at the banks, which is certainly maybe a surprise to some people. Now, what shouldn't be a surprise is a bank of this quality and of this dominance, certainly over the past 30 years or so, continue to consolidate the banking industry. Well, it's in a 30-year uptrend, if you will. We've deviated to the top. We've deviated to the bottom at times. Right now, we are smack dab in the middle of the range. A move to the top of the channel would be actually pretty darn significant. You make a new higher high over the November ones, and you're up here at north of 180, 190, maybe darn near $200 per share. You get up into this range. So you still got, honestly, if this technical pattern holds and you kind of have a move to the upside, You got $30 to $50 in upside with JPMorgan. A pull back to the bottom of the channel should take you back down to 120. You should be buying the bank at those levels, and you should make that decision now, because if JP Morgan pulls back to the bottom of the channel, those recession and all those fears are going to be, talked about on TV. And so you make these decisions now. And I encourage you to do that through earnings season as we look at these technical charts. The reason why you make the decision on the technical chart is it makes the decision easier. If we're sitting here trying to make the decision, going through these numbers, looking at EPS, looking at valuation, I think you're making it too complicated. Just look at a price chart and say, hey, if price gets here, I buy. If it price gets here, I'm thinking about selling. You do that with everything else you buy in your life. A stock should be no different. If you live in a condo building and all the condos in your building sell for $300,000, and then all of a sudden one lists for $200,000, what are you going to do? You're probably going to figure out a way to go buy that condo. And if the next day all the condo buildings soar to $1 million, well, what you probably going to do? Probably call your real estate agent and sell it. The same thing with stocks. When they get to a certain level, agree to yourself beforehand that you're going to buy it. When it touches a higher level, agree to yourself that you're probably not going to buy it at those levels. And if you do want to take profits, that's the area to do it. That's why we look at these charts, makes the decision making easier. It also projects and predicts the decision making for you. So when those levels are hit, makes it a hell of a lot easier. Guys, it is the start of earnings season. We'll be here for you every step of the way. We kick things off with JP Morgan, but obviously we've got very exciting tech stocks and all the rest as we move through the next couple of weeks. Hopefully you guys have a wonderful weekend. We'll be back later today with the Fang Stock Recap Show. Good luck with your investments.